Welcome to Books in Sum, your go-to for bite-sized book summaries.
Accepted Bitcoin practices. The ideas in Saifedean Ammous can be seen as a glimpse into the future of the financial sector. Since ancient times, people have used money as a medium of exchange, and now it plays a crucial role in international commodity trade. Gold-backed paper currency was a straightforward and efficient means of preserving purchasing power in the modern era. But governments gave up on the gold standard and started printing money at the start of the 20th century, ushering in a century of economic ups and downs and mounting debt. Bitcoin is a globally accessible and eternally stable means of storing and exchanging value. If it can get past its growing pains, it could usher in a new era of prosperity. An ancient rock currency died when new technologies emerged, and ever since Caesar, governments have devalued currencies to pay for their wars. Bitcoin is ready for its moment in the spotlight as the catalyst for a new era of prosperity. The Rye stones were used as currency by the people of Yap Island, Federated States of Micronesia, until the late 19th century. These stones could be seen from anywhere and were easily divided, but their worth and marketability quickly diminished over time. This started to change in the late 19th century when Irish-American Captain David O'Keefe was shipwrecked there. O'Keefe began bringing in a large quantity of Rye stones via modern technology in exchange for coconuts. Gold's exceptional properties, such as its indestructibility and inability to be artificially replicated, made it the foundation of reliable currency. Only in the 18th, 19th, and 20th centuries did the fascination with gold as money reach its peak. A rise in the use of ultra-convenient, non-physical forms of payment like checks, paper receipts, and bills was spurred by the rapid development of communication and transportation. Governments around the world came up with the idea of issuing paper money backed by precious metals, which they stored in vaults, to convince merchants and consumers that the pieces of paper they are using to buy and sell are worth anything. In 1717, Britain was ahead of the curve when Isaac Newton introduced the gold standard. By the year 1900, about half as many countries had formally adopted the same standard. Since gold was freely chosen by the markets as the best store of value, this currency was considered sound because it was backed by gold. In the 1st century CE, the aureus, a coin containing about 8 grams of gold, was issued by Roman Emperor Julius Caesar and quickly became the standard means of payment throughout the Roman Empire. The Roman Empire used a gold standard, but there was a major flaw: the gold could only be kept in a handful of bank vaults. This made it easier for paper currency to be converted into gold, but it also centralized monetary policy in the hands of governments. Nearly every major European power in 1914 took advantage of this by printing new money that wasn't backed by gold. As a result, governments were able to keep funding their war efforts with paper money for another 4 bloody years after gold convertibility was suspended. The value of existing currency, such as the Austro-Hungarian krone, fell precipitously as a result of this money printing spree. After the end of World War I in 1918, the victors and losers in Europe were faced with the difficult task of revaluing their currency, but doing so fairly in relation to gold would have been politically disastrous. Governments have increasingly intervened in the economy since the introduction of fiat money in an effort to maintain the value of their currency, creating an era of unsound money. By 1944, the Allies were preparing the Bretton Woods system, an economic order to govern the world after World War II. In this scenario, the International Monetary Fund would be responsible for enforcing a global currency exchange rate pegged to the US dollar. In practice, the United States broke the rules by artificially inflating the value of the dollar relative to gold, while other countries did the same with their currencies relative to the dollar in order to finance economic growth. The last time dollars could be exchanged for gold was when President Nixon made the announcement on August 15, 1971. In the future, the value of currencies would be set independently by the competition between the world's major fiat currencies. Long-term, sustainable growth can be achieved with the help of sound money, which encourages people to save and invest. In contrast, capital accumulation is distorted by unsound money due to the distortion of interest rates and prices. These two variables provide investors with the information they need to make sound decisions without requiring them to be experts in every aspect of the global economy. Recessions and the never-ending accrual of debt are just two results of unsound money policies, like those enacted by European governments during World War I. Central planning by the government distorts markets, especially the capital markets, and results in a boom and bust cycle. Recessions and the never-ending accrual of debt are just two results of unsound money policies, like those enacted by European governments during World War I. The Great Depression of the 1930s, for example, was caused by governments adopting policies favored by John Maynard Keynes, and these effects of artificially inflated money are the most important details in this text. Recessions, according to Keynesians, occur when governments and businesses spend too little money collectively. This has knock-on effects on people's propensity to spend money recklessly and make hasty, profit-seeking investments. Bitcoin's scarcity is part of what makes it special, and its rarity can aid economic growth, stability, and recovery. It shares characteristics with the gold standard, such as scarcity and predictability, reducing the likelihood that its supply will grow to a point where it devalues. Bitcoin is a digital currency that is mined via the Bitcoin network's computers competing to solve difficult algorithmic puzzles. Bitcoin's creator, Satoshi Nakamoto, built in an anti-boom mechanism. Every 4 years, the supply of Bitcoins is halved. Since the difficulty of solving algorithmic problems increases as the number of computers trying to solve them does, this ensures a steady and reliable supply. Bitcoin's security is one of a kind, as it is the only asset whose value is determined by its scarcity. The Bitcoin ledger uses a cutting-edge technology called the public blockchain, making the system extremely secure. Every user of the network has access to this public ledger, which details each and every blockchain transaction ever executed. There is no need for a governing body to maintain order on the Bitcoin network because it operates autonomously. There is also no need for a governing body to keep tabs on business because the system can function autonomously. Since would-be fraudsters need to expend considerable computational resources creating a fraudulent block, verifying transactions is simpler than cheating. However, if Bitcoin's security were compromised, users' trust in the network would quickly decline, along with the cryptocurrency's popularity and worth. Even though Bitcoin has the potential to become the new standard, it is beset by problems like market volatility and an increasing reliance on large, centralized institutions. Bitcoin needs to expand in order to become the new standard, but expanding would require ever more reliance on large, centralized institutions. Bitcoin was created to eliminate the need for a centralized authority, such as a bank, in the currency exchange process. The circle cannot be squared, so to speak. There are fees associated with using Bitcoin, and the daily transaction cap is at 500,000. To establish a new norm, authoritative bodies must be established to oversee the process. If Bitcoin is to usher in a new era of sound money, it must first work out its kinks and provide a framework for establishing a modern sound money policy. Bitcoin is a powerful medium of exchange, but it still has some growing pains to get over before it can usher in a new era of stable currency.
We hope you found this summary helpful in your listening journey. If you're interested in diving deeper into the topic or getting your hands on the whole book, be sure to check the description below where we've included links to the book and other related products that may be useful to you. Don't forget to hit that subscribe button to stay updated on our latest book summaries. And feel free to leave a comment with any suggestions or requests for books you'd like us to cover. Thanks again for tuning in and happy listening.